So in March 2023, one of America's biggest banks collapsed in just 36 hours. It wasn't because of a scandal. It wasn't because of fraud. It was to do with numbers. It was to do with ratios that were too low. So in this video, we're not going to calculate ratios. Most A-level specifications do not really require it. Or if they do assess it, they usually make the numbers very, very basic, which means as long as you understand what they mean and what is involved, you'll know what to do. And this understanding is the purpose of this video. So hopefully the video will help you to understand what they mean, why they matter, and again, this will help if any calculations do come up. So just remember, because behind every financial crisis you've ever heard of, it can usually be explained by such ratios. So maybe these ratios were perhaps they were ignored, perhaps they were manipulated, or simply they were just too low to absorb what was to come next. So I'm going to frame the ratios with an analogy. Imagine maybe you're a certain age and you go to the doctors for a checkup, all right? They're not just going to ask you how you feel. What they're going to do is they're going to run tests. Those tests will provide data, they'll provide numbers that tell a deeper story than any conversation could. Now, financial ratios do exactly the same thing, but for banks. So every ratio is pretty much asking the same fundamental question. And that question is, can this bank survive a bad day? So some are asking about tomorrow, some are asking about the next year, but they're all probing the same thing. And that is the bank's resilience. And as we'll see, the banks that have ignored these numbers, they didn't just damage themselves, they damaged everyone. And we see that systemic shock. So the first ratio that we're going to look at is cash ratio. All right, so we can see from the formula there, it's your cash assets divided by your current liabilities. Now, cash ratio is the simplest and the most immediate measure of safety. So think of it as just simply your wallet versus your bills due tomorrow. If you owe your landlord rent in the morning and you've only got 20p for every £1 you owe, well, that's clearly going to be a problem. That does highlight that you're insolvent. You might have savings, you might have investments, you might have assets, but right now, at this very moment, you cannot pay and you cannot meet your financial obligations. And that's exactly what a bank run exposes. And that's why it's very, very important to recognize what a cash ratio tells us if we fear a bank run might happen. So when depositors panic and that panic spreads fast and we have that mass hysteria, they don't want promises. They don't want assets that can be liquidated next month. They want cash. They want cash right now. If the bank doesn't have enough of it on hand, it doesn't matter how many loans it has on its books, it cannot meet the demand of its customers there and then. And that's precisely what happened to Silicon Valley Bank. Its assets weren't worthless, but they were locked in long-dated bonds that had fallen in value. So when customers started withdrawing, SVP just couldn't convert those assets to cash fast enough, and within 36 hours, it was over. So a higher cash ratio it might not have guaranteed survival, but it would have bought time. And in a bank run, I suppose you could say that time is everything. It's also really, really important to consider evaluating such arguments, because these cash ratios, they will come from regulators. And here's the trade-off. So cash sitting in a vault, remember, earns nothing. Every pound held as cash is a pound not lent out, not invested, not generating profits. And banks know this. And this is why, if they are left to their own devices, or if regulation is very light touch, they will always hold as little cash as what regulators will allow. So it's that tension, safety versus profit, and it does run through every ratio that we're going to look at today. Now, the second ratio is a liquidity ratio. It's going beyond cash, and it is looking at all current assets. The liquidity ratio broadens the picture. Rather than just cash, it asks, what can the bank convert to cash quickly within the next 12 months? So think of it as you not just checking your wallet, but your whole current account, your savings, anything you could access at a relatively short notice before a big payout goes out. It's a wider safety net than just cash alone. So here's why it matters, and here's why it matters beyond the definition. Banks don't fund themselves purely from customer deposits sitting in current accounts. Many rely on short-term borrowing, and that's short-term borrowing from other financial institutions, and that's known as like wholesale funding. It's cheaper, it's flexible, and in normal times it works perfectly well. The problem is that wholesale funding can evaporate overnight. So Northern Rock, 2007 textbook example of this. On paper, Northern Rock didn't seem to be in a crisis. It had mortgages, it had assets, it had customers, but its business model depended on constantly rolling over short-term borrowing from money markets to fund long-term mortgage lending. So when the credit crunch hit and those markets froze, Northern Rock, they just simply couldn't refinance. It had the assets, but not the liquidity. It couldn't meet its obligations as they fell due. And remember, those financial obligations, they are short-term. So the results, it was the first bank run in Britain for over 150 years. Queues formed outside branches. Customers who had never once thought about their bank's balance sheet suddenly wanted their money back immediately. And the more people withdrew, clearly the worse it got. And again, this is why regulation or more intense regulation came in after the financial crisis. This is why the Basel liquidity coverage ratio now requires banks to hold enough liquid assets to survive 30 days of severe outflows without central bank support. So regulators looked at the likes of Northern Rock and they concluded that you cannot leave liquidity management to the discretion of institutions whose incentives push them towards risk. So a bank with a higher liquidity ratio is better placed to absorb a shock. But again, you do have to remember, liquid assets tend to be lower yielding. So there's always going to be that cost of safety. And throughout this, you have to make sure that you are evaluating. So the capital ratio is the next one. The capital ratio shifts our focus from liquidity and short-term liquidity to longer-term resilience. It's asking a different question entirely. It's not can you pay your bills this month, but it's can you absorb serious losses without collapsing. So it measures how much of a bank's own money back the loan is made. So think of it as, I suppose, the bank's own financial reserves, the buffer that stands between bad debts and insolvency. So a bank with a high capital ratio has built its own cushion. If borrowers start defaulting, losses are absorbed by that capital before they threaten depositors or the wider system. So a bank with a low capital ratio, which we did see during the financial crisis, that they really have no margin for error. It's lending money it can barely afford to lose, and that was the problem. So to make this concrete, just imagine this. A bank lends out 100 million and they hold 5 million in capital. Now that's just a capital ratio of 5%. Now imagine a recession hits, so a big significant shock, 6% of borrowers default. Now the losses exceed the entire capital buffer. The bank is technically insolvent, and that, again, it's not hypothetical. That is essentially what happened across the banking system in 2008. So for the UK, an example is RBS. And in the years before the crisis, RBS had expanded aggressively. They had acquired companies, but some of those acquisitions turned out to be very, very, very poor corporate decisions. Its capital buffers were stretched thin across enormous balance sheets, and when toxic mortgage-backed assets started failing, there's just simply not enough capital to absorb the losses. The UK government had to step in, and they had to step in with a bailout of over £45 billion. So at its peak, the taxpayer owns, I suppose, over 80% of one of the world's largest banks. Now, this is another reason why the Vickers report that came out after the financial crisis recommended something called the bail-in method. Now, the bail-in method was to try to reduce this idea of moral hazard, and to make it where the industry itself was responsible for bailing out the sector rather than the government. And this is where capital ratios become bigger than just one institution, because banks, they're interconnected. They lend to each other, they hold each other's assets, they guarantee each other's position. So when one large bank's capital is wiped out, it spreads immediately, and it's like that contagion. Who else is exposed? Who else is next? And that's systemic risk. And it's why regulators after 2008 dramatically increased the minimum capital requirement under that Basel Act. Because a capital ratio isn't just about protecting one bank, it's about protecting the entire industry. And the bail-in method made it so banks didn't feel like they were too big to fail and that the government would just simply bail them out. It created, I suppose, a burden of responsibility that was incurred by the sector itself. So the next one, final one, is debt to equity. The debt to equity ratio gives us a completely different angle entirely. So rather than asking, can the bank survive today? Rather than asking, can the bank absorb losses? It's asking something else, possibly something more fundamental. It's asking how much of what the bank owns is actually borrowed. So let's imagine from like a personal viewpoint, you're buying your house, okay? You're buying your first home, it's worth £200,000, and you're getting a mortgage of £180,000. Now your debt to equity ratio is very high. You own the house on paper, but the reality of the situation is the bank owns most of it in practice. So your own stake, your equity is only £20,000. A relatively small fall in house prices leave you with negative equity. Now, what negative equity is, it means when owning less than you owe. Now, scale that logic up to a global investment bank. And let's think about Bear Stearns in the years before 2008. It was leveraged approximately at 30 to 1. So for every £1 of their own capital, they had borrowed £30. In good times, that's great. It amplifies your returns enormously. Small gains on a huge asset base translates into massive profits. But you have to remember that leverage works both ways. So when the assets that Bear Stearns held, which were largely mortgage-backed securities, started falling in value, the losses were amplified. Exactly the same way. A fall of just 3 or 4% in asset values was enough to wipe out their entire equity base. There was no buffer, there was no margin for error, and the firm collapsed in March 2008, requiring an emergency rescue by JP Morgan, which was facilitated by the US Federal Reserve. So the debt to equity ratio had been screaming a warning for years, but when leverage is generating extraordinary profits, there's very little appetite to listen. And this is why regulators now scrutinize leverage ratios so closely. Because a bank that's borrowed 30 times its own capital, it isn't just a risk to itself, it's a loaded gun pointed at the rest of the financial system. Now, just remember, every ratio we've looked at today reflects the same fundamental tension, that trade-off. Left to themselves, banks, they tend to lean towards profit over safety. That's not irresponsible. You could argue it's rational behaviour. But more lending, more leverage, more returns, but more risk. And crucially, more risk that is often borne not just by the banks, but by the taxpayer, depositors, and the wider economy. And this is where moral hazard comes in. And moral hazard, it definitely could be seen at the heart of banking in 2008. If a bank believes it'll be bailed out when things go wrong, if they believe that they're too big to fail because the consequences of the collapse are just simply too severe for the economy, then I suppose it has every incentive to take on more risk than it should. The rewards go to the shareholders, so they're happy if they see those rewards, but unfortunately the losses go to everyone else. Ratios, they only really become a meaningful flaw when someone enforces them, and that's the importance of regulation. And that's why regulators exist. The Basel framework, it didn't emerge from goodwill, it emerged from the wreckage of 2008. When governments around the world discovered what happens when such numbers are ignored and the bills they do land with the public. So this is a key evaluation point. And I suppose it could separate good answers from great ones. Making banks safer, it does have a cost. Higher capital requirements does mean less lending. Less lending means less investment, fewer mortgages, slower growth. If we think about higher liquidity requirements, it does mean lower returns. Those returns, unfortunately, those lower returns, it can be passed on through higher borrowing costs or lower saving rates. The question regulators need to kind of explore is how safe is safe enough? It's always who pays for the safety and what do we have to sacrifice to get it? They have to make sure that that regulation is not excessive, that it limits the growth of the financial sector. Think about the UK. The financial sector is so important to the UK economy. If we limit growth, then we might make those banks narrow. We might not give them the opportunity to diversify, to innovate. And then if they diversify, if they innovate, think about the returns for the economy and think about what that does for the UK economy. Right, so finally, just remember this. These banks, they didn't fail overnight. The warning signs that were there, they were in the ratio long before the queues formed outside the door. So just remember the ratios, it is your job to tell the story behind them. So whenever you see a ratio in an exam question, ask yourself 3 things. Is it high or is it low? What does that mean for the bank's safety? And what is the cost of changing it? If you get those questions right, then you're on your way.